you Smarter Than a Libertarian. Today we're diving into a highly debated topic, the so-called Mar-A-Lago Accord, a rumored plan to weaken the U.S. dollar in order to boost American exports and address the country's debt. This idea echoes the famed Plaza Accord of 1985, which aimed to push down the dollar's value but ended up being less than successful. Let's unpack why this proposed devaluation strategy might be misguided and why a strong currency is generally better for American workers, savers, and the overall economy. This article comes from Mises.org. I will include a link in the description to the article. So, what is the Mar-A-Lago Accord, you may ask? The media has been buzzing about a potential agreement between the U.S. government and its main trading partners, supposedly meant to lower the value of the U.S. dollar. Proponents say that a weaker dollar could make American exports cheaper abroad and help rebalance trade. There's also talk of restructuring U.S. debt, swapping existing obligations, which are due within the next year, for ultra-long-term bonds like 100-year Treasury bonds to reduce short-term fiscal pressure. However, this article that we're summarizing makes it clear that these ideas rest on two faulty assumptions. Assumption 1, U.S. exports are low because the dollar is too strong. Assumption 2, government debt is unsustainable because of a robust dollar. Now, which one of these do you think is probably the most important one? I think the U.S. exports are low because the dollar is too strong. And according to this article, neither of these assumptions holds water. Why the U.S. doesn't depend on exports like other countries, U.S. exports only represent about 11% of the nation's GDP. And we need to keep that in context. We are not an exporter nation in terms of GDP. Now, this is small compared to other places like Germany, the UK, or Japan. But the United States is a huge and mostly self-sufficient market, rich in natural resources. Businesses can thrive by selling domestically instead of scrambling to export. The U.S. is the largest oil and gas producer in the world, even though we're not part of OPEC. And the total value of its natural resources is around $45 trillion. This internal abundance reduces dependency on importing and thus reduces the pressure to export. Now, with 331 million people and consumer spending making up 70% of GDP, there's simply a massive market here at home. Services, which are central to the U.S. economy, we've gone from a manufacturing to a service-based economy, are also more challenging to export. Plus, when you already have a large consumer base locally, you're less motivated to look abroad. I mean, if I can sell products in my own city, why am I looking to pay transportation costs to another city? In short, a strong dollar doesn't hamper U.S. exports as much as many people would suspect, but that's the narrative they're pushing. The U.S. just isn't structured like some export-driven economies, Germany or Japan, for example. So it's apples and oranges to compare their export ratio. And that's what we have to do, is we have to look at this more holistically and stop having the appeal to emotion used on us to make us stop rationally thinking. 3, devaluation does not magically fix our debt. And that's what politicians talk about. Reduce the debt. Well, devaluation doesn't do that. Another part of this Mar-A-Lago Accord rumor is the idea of issuing much longer-term bonds, 100-year treasuries, to reduce immediate debt pressure because we have like $9 trillion in bonds coming due within the next year, I believe. But there's a catch. If the government gets in the habit of trying to solve debt problems by simply devaluing the currency, investors may lose faith. It's basically kicking the can down the road. It's like if you watch the NFL, you see how the Chiefs structure contracts. They just keep kicking it down the road. You have to pay it sooner or later. So yeah, that's how that works. But I ask a question to everyone who views this. Who wants to buy a 100-year bond if there's a real chance the U.S. might deliberately weaken the dollar again, eroding the value of that bond? Are you really willing to invest in it and tie up that money for 100 years that could be used to build a business or give you a better rate of return? Devaluation can act like a stealth default because it shrinks the purchasing power of the money you use to repay your debts. Over time, it scares off both foreign and domestic investors. We are actually looking at a downgrading of our credit rating as a country. Let that sink in. Inflation, the hidden threat. The United States has already seen elevated inflation around 24% over 4 years due to aggressive fiscal and monetary policies, which some of it I didn't like. Pumping more money into the economy or weakening the currency further could stoke the inflationary fire. In practical terms, that means higher prices for everyday goods and services. For working families, this is bad news. Your real wages and savings lose ground when prices jump. A weaker dollar doesn't boost productivity or innovation. It just drives up the cost of imports and domestic goods alike. Remember, if devaluation were a ticket to prosperity, places like Argentina or Venezuela, where the currency has collapsed time and time again, would be economic powerhouses. Clearly they aren't, although Argentina is moving in the right direction, but that's what happens when you elect a libertarian. Stuff generally moves in the right direction when you get rid of both the right and the left and you move to a libertarian. But here's the thing. Why a strong dollar helps the U.S.? Low inflationary pressure. A stronger dollar reduces the cost of imported goods, helping keep everyday prices in check. Lower interest rates. When the dollar is stable and in demand, both government and private borrowing costs can be kept lower, which is good for businesses and families alike. It attracts investment. Capital flows into strong currency countries. Foreign direct investment is a major driver of job creation and technological advancement. Global reserve currency status, even though BRICS is trying to do something to stop that, it's probably not going to happen for the next 50 years. The dollar is the world's reserve currency partially because it's viewed as stable and reliable. Undercutting its value deliberately could jeopardize that status in the long run. Here's a better path forward. And this is what me and a lot of libertarians believe we should do. Instead of currency manipulation, which is just robbing Peter to pay Paul, the U.S. needs real structural fixes, but neither side wants to do that. Streamlined regulations and tax reforms so that domestic companies, especially manufacturers, remain competitive. This is what no one wants to say: spending discipline and a curb to endless monetary easing that cause balloon and then bust cycles in the money supply. A strong economy doesn't need to rely on artificially weakening its currency. If anything, it thrives by showcasing true productivity, innovation, and high value industries that people want to invest in and buy from. So let's put a nice little bow on this and get ready to call it a night. So that's the gist of the critique behind the Mar-A-Lago rumor. The bottom line is a weaker dollar might look like a quick fix for export numbers, but quick fixes don't really work. But it often leads to rises in prices at home, undermine global trust, and fails to fix the real issues that are driving our debt, which is overspending. The U.S.'s comparative lower export to GDP ratio isn't proof of failure, it's a reflection of the country's enormous, self-sustaining market and heavy focus on service industries. If America truly wants to remain competitive, it's better served by embracing genuine productivity, innovation, and a stable currency rather than a race to the bottom through devaluation. And remember, folks, if hurting your currency were the key to success, the worst off economies would be the richest. History shows that this is clearly not the case. Thank you for tuning in to Are You Smarter Than a Libertarian? My name is Jeff Metrick. I really hope you enjoyed this breakdown. And if you want to share this breakdown with other people, please share it, comment, like, and subscribe. It helps build the channel, and it just helps me to invest more into making this better. So until next time, stay free, stay informed, stay accountable. I'll see you all on Wednesday.